normally, if a macro event like the Strait of Hormuz were to happen, clearly Bitcoin, gold, bonds, anything that was used as collateral in someone's account that they were speculating with margin on stocks or futures or whatever it is, and you get a big drop, you get a margin call. People don't sell what they can. I mean, what they want to sell, they sell what they can sell. And so that's why if you go back to lockdowns, right? Bitcoin dropped 50% in like 13 hours. People are like, whoa, why? Well, gold dropped, bonds dropped. It's because when your stocks drop and you've got margin call, you can't sell the stock to cover the margin call. That's the whole problem. And so you sell what you have left.
To understand Bitcoin's volatility, you need to understand one word: leverage. In previous cycles, investors were taking extreme risks, borrowing money to amplify their bets on Bitcoin and other crypto assets. We're talking about 25x, 50x, even 100x leverage. And that's where things get dangerous. When markets drop, leverage positions get liquidated. This triggers a chain reaction. Fall, margin calls are triggered. Investors are forced to sell. More selling pushes prices even lower. But here's the key insight. Investors don't sell what they want to sell. They sell what they can sell. That's why during major crashes, everything drops at once. Bitcoin, gold, stocks, even bonds. We saw this clearly during the early days of the COVID-19 market crash, when Bitcoin lost nearly 50% of its value in hours, not because it failed, but because investors needed liquidity fast.
I think it has very, very little to do. And that's actually a little bit of happenstance in the sense of the drop, the crash, whatever you want to call it, the drop, the end of crypto fall and the move into crypto winter happened from October of last year kind of into January. So pre all the Iran war issues. And so normally if a macro event like the Strait of Hormuz were to happen, clearly Bitcoin, gold, bonds, anything that was used as collateral in someone's account that they were speculating with margin on stocks or futures or whatever it is, and you get a big drop, you get a margin call. People don't sell what they can. I mean, what they want to sell, they sell what they can sell. And so that's why if you go back to lockdowns, right? Bitcoin dropped 50% in like 13 hours. People are like, whoa, why? Well, gold dropped, bonds dropped. It's because when your stocks drop and you've got margin call, you can't sell the stock to cover the margin call. That's the whole problem. And so you sell what you have left. And so that isn't happening right now. So we don't have that downward pressure on Bitcoin like we're seeing in other markets because the leverage got flushed out.
Those people sold.
Yeah, people sold in the fourth quarter and into early January. But more importantly, the leverage, the forced selling, and you've talked about this many, many times in your stream. Like, when did people actually think it was a good idea to buy, an 80 vol asset on 50 times leverage or 25 times leverage? I mean, it used to be 100 times leverage and it was worse. But that's never been a good idea. And, your question earlier about, why are people, going into this oil trade, at $117? Like, well, because humans are gonna human. Humans do two things. We buy what we wish we would have bought, and we are spectacular at that. I mean, look at all the flow data on any asset in the history of time, and you will always see more coming in literally right at the peak of anything. And that's just because we're human. It feels good to buy something that everyone else has already bought. Now you're part of the club. You're in the herd. And the second thing we do is we sell what we're about to need. And that's the most frustrating part is like you watch people, they have an asset that they believe in, and it corrects for whatever reason, right? It can be lots of reasons. It can be technical reasons, it can be fundamental reasons, but the asset corrects. And they sell it. And there was a tweet this morning as I was having my coffee, says, I really wish I wouldn't have sold my Bitcoin at 8 cents down from 30 cents. I'm like, yeah, you probably shouldn't have sold it at 8 cents. But that's the problem is back then the volatility wasn't 80. I mean, it was a ginormous number. And people get shaken out because they're paying attention to the movement instead of paying attention to the signal versus the noise.
One of the most fascinating insights Yusko shares is about Bitcoin's intrinsic support level. He explains that Bitcoin has never traded below its electricity cost of production. Why? Because miners who produce Bitcoin won't sell at a loss unless they're forced to. This creates a natural price floor. Right now, that floor is estimated to be somewhere in the high 50K range. So if prices approach that level, selling pressure decreases, buyers step in. Market stabilizes. It's a powerful dynamic that many investors overlook.
Because it's 71K, right? Oh my God, it's going to zero. Like, what do you mean it's going to zero? And based on it was 126 and now 71. Like, right. But a year ago, it was 75. And 2 years ago, it was 45. And so and again, we've talked about this, is the difference between an accumulation pattern and a distribution pattern, right? An accumulation pattern is one where you're making higher highs and higher lows. It doesn't mean there's no volatility. There's still volatility, but each successive wave, you're accumulating the asset. I mean, accumulating the group.
Yeah.
Distribution is the opposite, right? You're making lower lows and lower highs. It's like a rubber ball bouncing down a set of stairs. Again, doesn't mean the volatility is not high. That's literally the kinetic energy. The rubber ball bounces each time it hits a step. End of the trip is a bad place. And you can say, well, Bitcoin's being distributed. People are selling. Well, let's actually look at the data. Who is selling? Small traders are selling. People who bought in October are definitely selling. There's no question that data is incontrovertible.
Yeah, I'm done here. I tried.
Yeah, and I'm out. I lost money and I'm out.
Yeah.
But who's buying? Whales. Interesting, right? I mean, I thought the whales were selling. Well, but there was one whale that did sell a big bag, but most of the data shows that the whales are actually continuing to accumulate. And more importantly, you said it, Morgan Stanley and other institutions are fine, like, okay, fine. You know what? I resisted. My clients are saying they're going to fire me. Fine. We'll actually create a way that you can do it so that we can control it and get some fees. So that accumulation is easily seeable. I don't know if that's even a word. Visible. It's easily visible if you just look at the data, right? We are making now higher highs. We're making lows, but they're higher lows. And you said it at the very beginning. What happens if we get one more shakeout down to the 63 or 57, 58? And why do 57 and 58 matter? Right now, that's, depending on who you talk to, the electricity cost of a Bitcoin.
Yep.
And the interesting thing is, and this is actually pretty interesting, Bitcoin has never, and I hate saying those words ever and never, but it actually is true. It's a fact, it's never traded below the cost of electricity. It's traded below the cost of production because you got computers and space and cooling, but the actual cost of electricity, it's never traded below that. And that is logical, because if it cost me that much, the incremental marginal cost to produce it, I probably won't sell it for a price lower than that unless I'm forced. And miners, the nice thing is they're mostly not forced. They can choose when they sell. And they can sell in the futures market and hedge, which is a whole nother story. But I like the accumulation pattern. I think we're in crypto winter. I think crypto winter ends in September. Now, how do you say September? Well, it's 364 days after the peak. Yeah, I mean, there's one thing that concerns me, and it's not a huge concern, but it does concern me. And now Tom Lee, as usual, is concerning me, because anytime people say we're going straight to the moon, I'm like, oh God, that's a bad thing. So I don't think the ceasefire is the starting gun. I don't. One, I don't think we ceased firing. I think there's stuff still happening. But more importantly, the thing that bothers me is Tim Peterson. I love Tim. Tim is one of the smartest guys in our space. He's very logical. He's very practical, very focused on the numbers. And he tracks a bunch of different things. So he's where I get my Metcalfe's Law fair value model. And that says, high 70s, low 80s. That's a pretty good place. That means we're below fair value, which means people who are investors, long-term accumulators of assets below fair value, should be buying it, and we are. So, but he also showed a chart where the mempool is empty. And the only other times that has happened has been in the middle of crypto winter, and we went down another 50%. So I'm not predicting that, and but I can't ignore that piece of data, and I can't ignore that low activity in the mempool is real. But I had this conversation with, I'm partners with Pomp and Jason on our first two funds, and then I have two new partners for my later funds, but we still are running the first two funds. So I meet with those guys every Monday. And Jason made a good point the other day. He said, yeah, I hear you, but most of the transactions now aren't happening at the base layer, right? And that is a good point, in the sense that we haven't achieved what you and I hope for, which is, the full L2 and L3 and L4, so that we have a system of money that works at the base layer Bitcoin, the way money today is the base layer of gold. And then you've got, Fedwire and ACH and Visa, MasterCard. So we're not quite there. We're pretty close, but we're not quite there. So I'll accept that over the past 12 years, that has changed a lot. And so there are now more people with Coinbase accounts or Kraken accounts, and those don't show up immediately as mempool numbers. So I'm willing to accept that, but it still bugs me a little bit.
Despite his overall optimism, Yusko does highlight one concern: low network activity. Specifically, he mentions the Bitcoin mempool, the queue of pending transactions. Historically, when the mempool becomes very quiet, it has sometimes signaled deeper downturns ahead. However, there's an important counterargument. Today, many transactions happen off-chain through platforms like Coinbase and Kraken. This means on-chain activity may look, but real usage could still be growing. So while it's a signal worth watching, it's not definitive.